Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. During these strenuous times of extreme market volatility, it is important to put events in context and take a longer-term perspective. Setting emotions aside, clear heads and rational thinking prevails, and it becomes possible to shift from fear to opportunity. Join us in our Quick Take series, where we look at the impact of COVID-19 across various world regions and discuss how our sub-advisors are responding.
Hi, I'm Ruchi Rathod, Director of Product Management at Sun Life Global Investments. I'm with Rob Almeida, Portfolio Manager and Global Investment Strategist at MFS. Rob, with the recent spike in volatility, can you share your views on what's happening in the markets?
Let's take a few steps back before all this began. So during late cycle periods, as we've been talking about for some time, investors tend to underestimate risk and overestimate liquidity. And this is why market vol is low late in the cycle and pre-crisis, because investors are assigning low odds of a negative market event. Now, lower vol naturally invites more risk-taking, which depresses vol further, and so on, and it works until it doesn't. And when it does it is when the market is presented with something new that it doesn't understand, or at least hasn't incorporated into its discounting methodology, like this virus, which obviously caused a huge spike in volatility, particularly the last week and a half. So now the market is struggling with this new variable and how this is going to impact financial assets. I guess in times like this, what I would say, I find it helpful to simplify things. So at the end of the day, business fundamentals drive cash flows. And those cash flows, profits, et cetera, drive asset prices, period. So let's look at that. So before the virus, valuations were in the top quartile for equities and top quintile for credit. So they weren't cheap. But more importantly, profits, cash flows, earnings, et cetera, in our view, were unsustainably high because the bulk of it was driven by financial engineering. It didn't come from selling widgets or raising the prices on widgets. It came from cost controls, buybacks, et cetera. So it lacked durability. It lacked sustainability. And so this meant, at least to us, financial markets were actually more expensive than what they appeared 3 or 4 weeks ago. So media and market participants right now are all blaming this sell-off on COVID-19. And the virus was certainly the spark or catalyst that lit the fire, but it was really years of dry conditions that brought us to where we are now. Just getting back to your opening question, what's happening in markets? The market doesn't know what it doesn't know, and it's shooting first, and it's going to ask questions later. And I guess last point I'll make is that this began as a medical crisis. It was compounded by an energy crisis, and that has led and created a liquidity/financial crisis, which really gets to your question. So, which is why the Fed cut rates to zero on Sunday, set up liquidity lines to restore market functionality, at least to the Treasury and to the mortgage markets, because they're not functioning properly. They're better today, but still not nearly where they should be. Liquidity is terrible, absolutely horrendous. So I expect that we're going to see measures from the Fed, really from Congress ultimately, that will allow the Fed to fix the commercial paper or short-term credit markets, because this is clearly what capital markets, equity, credit, et cetera, this is what they're demanding.
Given the views you've just shared on liquidity and volatility, are there parts of the market that you find more or less attractive? And I guess I'd ask if you see this as an investment opportunity.
Well, obviously I can't go into details about trades that we're making, but I'll say this. In up markets, investors tend to focus on the upside. In down markets, they focus on the downside. I think they should be doing the opposite, meaning in up markets, you should be thinking about the downside, and in down markets, you should be thinking about the upside. So how do we do that? One, our focus is on simply, what does this company do? Are they really needed? Can they keep doing it? What's their liquidity profile? What's their balance sheet strength? Translation, are they going to survive? If the answer to that is no, then you move on. If the answer to that is yes, the next question is, are they going to be forced to dilute shareholders with a big capital raise once they come out of this? You saw that with a ton of regional banks coming out of 2008. They survived, but they had massive capital raises, which impaired earnings for years. So if the answer to that is no, then we can start thinking about and modeling, well, what's the upside? How many competitors are going to go away? Are they going to be able to take share? Are they going to be able to increase units and keeping costs fixed or flat? How is this going to better this company we're getting it at a 20, 30, 40% cheaper discount than we were 4 weeks ago? So these are the types of names, or at least the types of discussions we're having, and these are the types of names that we naturally want to lean into when the market doesn't want them.
Thanks, Rob. I really appreciate you taking the time to speak with us.